Hi, my name is Ryan Smillie. I'm here today to talk about RRSPs and hopefully give you a better understanding of how to use them to your advantage. So what we're going to do today is talk about RRSP accounts, using them to your benefit, and provide examples of when it makes sense to use RRSP accounts. So the benefits of a registered retirement savings plan are that they allow you to reduce your income taxes now or in the year of contribution, deferring payment of taxes until time of withdrawal. Withdrawals should be made in years when your income is low, usually retirement. So RRSP savings grow tax-free inside the account, which allows your investments to grow fully and compound fully until you need the money. So RRSP accounts don't pay tax on an annual basis on investment gains, such as interest, capital gains, and dividends. You only pay tax on those gains when you take the money out of the account. This is unlike a non-registered account where you would pay tax on an annual basis or as you realize the gain. So reducing your income tax now. So an example of this would be an individual making $125,000 a year, makes a $10,000 RRSP contribution. That would reduce their taxes by approximately $4,037 if they're a BC resident. This is a 40.37% tax refund on the contribution amount. So deferring payment of taxes until time of withdrawal. Withdrawal should be made in years. So example of this is, say that same person who put $10,000 in the previous example and got $4,000 back. Now they're retired and they've got $35,000 in pension income and $10,000 in RRSP income, or they take out $10,000 of their RRSP that year. They would pay approximately $2,092 in taxes on their $10,000 RRSP withdrawal, whereas potentially even the year previous, they got $4,000 back in taxes for making that contribution. Now they're taking it out and only paying $2,000 in tax on the withdrawal. So that's right there. It's roughly a 20% benefit for putting the money in the year of high income and taking it out in the year of low income. So what is a spousal RRSP? A spousal RRSP assists couples with unequal savings or income by allowing them to shift retirement savings from the spouse with a higher income tax rate and higher tax rate to the one with a lower income and tax rate. So just a few points here on spousal RRSP account setup. So the account holder is usually the lower income spouse. The contributing spouse is the higher income earner. So the contributing spouse receives the tax break and contributions go against the contributing spouse's RRSP deduction room. So when would you use a spousal RRSP? So an example of this would be a couple, Jack and Jane. So Jack earns $45,000 a year. Jane earns $180,000 a year. If Jack makes an RRSP contribution, hypothetically, he would receive a refund of 22.7%. If Jane makes an RRSP contribution, she receives an approximate refund of 46.02%. So in this example, a spousal RRSP would make sense, and it would be opened up in Jack's name with Jane as the contributing spouse. So the RRSP would be in Jack's name. Contributions receive the tax break on Jane's marginal tax rate, and it would count against her contribution once again. So how much should you contribute to your RRSP account? There's no hard and fast rule to how much you should contribute to the RRSP account each year. Many factors go into whether you should be contributing to an RRSP and how much you should contribute. Examples of contribution factors, whether somebody should be putting money into an RRSP account or not, would be retirement income goals. You already have enough saved to meet your income needs in retirement. Marginal tax rate now versus retirement. So are you making relatively the same amount or close to the same amount now as you are in retirement? So if somebody's making $40,000 a year now, and they expect to be making relatively the same when they add up their pension, their savings, etc., in retirement, it may not make sense. It probably actually doesn't make sense for them to use RRSP accounts as a savings vehicle. They'd be better off, that person would be better off using a TFSA. So expected taxable income now versus retirement. We just talked about that. So what other sources of taxable income do you expect in retirement? So you add up your CPP, your OAS, your pension, potentially a pension, other savings. How much taxable income are you going to have in retirement, and how much taxable income do you have now? So current level of RRSP savings. Once again, if you already have a ton of money in RRSPs, may not make sense to add to it if you're going to be in a similar tax rate in retirement as you are now. So if you don't use your full RRSP contribution in a given year, do you lose it? No. So RRSP contribution room accumulates over time, carry forward as long as you want, and that number can be found on your notice assessment each year. So if you don't have the money now to put in your RRSPs, but you think maybe a couple years down the road you'll be able to really save and take advantage of the tax breaks later on, maybe you even plan on, or you expect to be making more money and be in a higher tax bracket later. So maybe you want to accumulate your contribution room for a little bit, and it'll just build up every year so you don't lose it at all. So what if I max out my RRSP contributions for the year, but you still have some money you want to dump in there and get ahead for next year? Maybe you don't want to have that money sitting in your checking account because you're afraid you're going to spend it on something stupid or something fun or irresponsible. Then maybe you want to put that money in the RRSP account in January, February, even though you don't have any room left. You can get ahead and make that contribution, just not claim it until the next year if you figure you're going to build up some more room. So what happens to my RRSP holdings when I retire? So when you enter retirement, you will want to strategically plan to withdraw your RRSPs and convert your RRSP accounts into a RIF account. You'll want to plan your withdrawals so you pay the least amount of tax over your lifetime. So a big mistake we see a lot of people making is wanting to defer payment from their RIF account or RRSP account as long as they want, or as long as they can, sorry. And this isn't usually advisable. So what happens to those people is they end up building up a significant amount of money in their retirement account. And then when they're forced to take out money, they are forced to take out an amount that puts them into a much higher tax bracket than they would otherwise be in if they took level payments over their entire retirement years. So another thing this causes OAS clawback. So if you it might push you in another tax bracket and also put you in a position where you're getting some of your OAS benefit clawed back because you're have too much taxable income. So that's another downside. Another one would be you just have all that money in there, and then when you pass away, then it gets fully taxable. So an example of this would be someone has $300,000 in their RRSPs when they pass away. That money is just added to your taxable income in that year of death. So say you had $50,000 in taxable income otherwise, plus the $300,000 in your RRSPs. So your income for the year on paper is $350,000. You're going to be paying a lot of that money, or a lot of that income is going to be in the highest tax bracket, giving away half that money to the government. Whereas if you evenly distributed that income over your whole retirement, maybe you would have never paid more than 20% or 22% tax on it. So it's always good to strategically plan your withdrawals so you use up all your RRSP money over your lifetime. So just a couple examples of using RRSP holdings for something other than retirement. So you can take out right now up to $35,000 tax-free through home buyers plan. So if you're a first-time homeowner and have RRSPs and you need a little bit more money to put down on your first home, then you can essentially borrow money from your RRSPs and use that as part of your down payment. Likewise with the lifelong learning plan, you can take out $10,000 tax-free out of your RRSPs to finance full-time training and education. Once again, you have to pay that money back, but you can take it out and use it at that time. So just a summary of RRSPs. So an RRSP account is a vehicle that allows you to save now for the future. RRSP accounts allow you to adjust your taxable income on an annual basis. So lower your taxable income in years of high income, and then take out in years of low income. So your investment grows tax-free until time of withdrawal. So there's no taxes paid on any investment gains until the time of withdrawal. All right, thank you very much. I hope you enjoyed the presentation. And if you have any questions, don't hesitate to contact our office and ask an advisor. Thank you.